Hi, I was just looking at the YouTube video when I was speaking in Sochi, Russia at the 8th Annual Bankers Conference. And one of the things that I was pointing out is that there is some deflation coming. But I want to be really clear here. I said in my book, and I've said over and over and over again, that we're on this roller coaster ride. And there's going to be the threat of deflation followed by Ben Bernanke overreacting and causing inflation. And it's going to be followed by a real deflation sometime. And I don't think that, it could be that the foreclosures that we've already seen and the crash of 2008 was the deflation, but I don't think so, because there hasn't been enough of the excesses cleared out of the system. We're in this long-term cycle, and there has to be what's called a credit revulsion, where people just will not take on any more credit. And to get to that point, they all have to get burned. More people have to lose their houses. More people have to lose their margined trading accounts. We need something that happens that will cause these excesses to be flushed out of the system. Now, I said that there's the possibility that all the charts were suggesting, this is technical analysis, by the way. And technical analysis, when you're doing charting and stuff, that's only right like 45% of the time. 55 to 60% of the time, so it's wrong 40 to 45% of the time. It's just that the charts are backed up by the markets being fundamentally overvalued and real estate still being in a bubble. These things have to unwind. You can't have markets with PE ratios in the stratosphere forever. It's just not possible for that to happen. The markets are a weighing machine in the long term. They're a voting machine in the short term. They do what everybody, the whole crowd rushes into one side. They all want paper assets and they push stock prices up really high. But over a 20-year period or longer, what you see is that the markets are trying to seek this equilibrium. And they always have to return to fair value, and then they overshoot it and they go to the opposite extreme. So we need to go to severely undervalued in the markets. Meaning PE ratios under 10, probably 7 or 6. Dividend yields over 6, 7%, 8%, 10%. We're at 1.8 today. When I did this video, we were at 1.9. The lower the dividend yield, the higher, the bigger the bubble is, the more overvalued that the stocks are. The reason that we're back up into these high PEs and we're into lower dividend yields is simply because the Fed created a bunch more base money. And so everybody just assumes that that's going to instantly create inflation. But base money is the most inefficient portion of the monetary supply. The Federal Reserve creates currency and they put it in the banks, or they spend it through deficit spending through the government, and it enters the currency supply very slowly. Most of our currency supply is created by the banks doing fractional reserve lending. You or I go out and we buy a house, or we buy a car, or a business opens up and decides to build a commercial building. We borrow money from the bank, and the bank is basically creating currency by robbing somebody's deposits and loaning those out, but then we're going to hire somebody to build a house. It directly goes into the economy right away. And it makes the economy boom because that money hired somebody, it bought something, it did something instantly instead of just going and shoring up banks' balance sheets. All that currency that the Fed created went on banks' balance sheets to basically instill confidence in the public in the banks, to make the banks look like they aren't bankrupt. And they were bankrupt, and they were going to fold if something wasn't done. And Ben Bernanke did it. He created a whole bunch of currency, which isn't just, they don't just print it, they don't just create it. They borrow it. The Fed buys a bond. That bond promises to tax you and I in the future. So we borrowed prosperity out of the future so that he could then give it to the banks to make everybody trust the banks again, and then paid the banks interest on those, if they leave that money in their checking accounts. And that interest, you and I have to pay for also. So we're going to pay interest in the future through taxes so that the Federal Reserve can make these bankrupt banking institutions look like they're not bankrupt, so that there's still confidence there, so the economy doesn't collapse. People don't realize the economy is psychological. There's no hard and fast foundation to it now. Ever since we went off of an economy that was based on real money, gold and silver, and went to an economy that is based, our entire currency supply is made up of nothing but IOUs or receipts for IOUs. That is the currency supply, and there is nothing else. Now, when I talk about deflation, I'm talking about monetary deflation. I'm not talking about what prices are today. It's the expansion and contraction of the currency supply, and then eventually prices follow. Now, one of the things that can cause a deflation here, and gold can even go up during this deflation. Let's take a scenario where the euro starts to fall apart. And I've been talking about this ever since people started asking me questions about, well, how could it possibly be that there's going to be $10 oil, and I didn't actually say, I said as low as $10. Maybe $30, maybe $50, but oil is going to take a dip, and so are all the other commodities, before big inflation or hyperinflation. I think we're going to end up in hyperinflation someday. But it's going to take this dip. Now let's take a scenario, for instance, that could happen. Let's say that there's a problem with the euro. Let's say that another country needs a bailout, and this time Germany, the Deutsche Bank, isn't willing to just stand behind all of this. Let's say one of these countries doesn't get bailed out. Let me see. I've got, well, I won't go through it here. A newspaper article, but right now Portugal is in some deep doo-doo. So there's another Euro country that is requiring a bailout. I said in my book, and I've been saying this since I read it on the CIA fact book back, I think, in 2004. The euro is a doomed currency. It was a very poorly designed currency. You can't have all these different countries with different monetary policy sharing one central bank and one currency. It won't work. It can't work. And it's not working. You're seeing this. I mean, Greece and Ireland are going to need further bailouts eventually. These countries are going to start falling like dominoes. And if a major player that has sound fiscal policy decides to step out of it. For instance, if Germany decides, well, we're just going to go off the euro and go back to Marx, it's all over with. It'll fall apart. Now, when that happens, it causes what's called a flight to safety. And the flight to safety is into basically two assets, U.S. Treasuries and gold. Those are the safe haven assets. If the euro and other foreign currencies start to have problems, there would be a flight toward U.S. Treasuries. The dollar would go way up, but there would be a slowdown in the world economy, including the U.S. Economy. So even though the dollar is going up in exchange rates, the currency supply is contracting. And since oil is priced in dollars and we import most of our oil, that means if we've got a stronger and stronger dollar, the price of oil goes down. So there is a scenario where gold can go up while all these other commodities like oil are falling. There's a number of scenarios that you can think of if you really go through this and analyze it. Now I want to show you something here. I'm going to take you to this is the St. Louis, it's economic research, Federal Reserve Bank of St. Louis. And I want to show you some real deflation. Here's commercial and industrial loans at all commercial banks. And you see that it goes up and we have a recession, and it goes up, we have another recession. Each time there's a recession, it kicks off this contraction of loans. When you take out a loan, you're creating the currency supply. Base money before the bailouts was only about $825 billion, and about $800 billion of that was the currency in circulation. The rest is deposits that are at the Federal Reserve, it's deposits that the commercial banks have in their checking accounts at the Federal Reserve. Then Ben Bernanke bailed them out, and he more than doubled the base money portion of the currency supply. But base money was a very small portion. The total currency supply is total outstanding credit, which is up in the 50 trillions. So $825 billion is nothing. So you're only talking about a few percent of the currency supply that Ben Bernanke has direct control over. The rest of it, all the Federal Reserve can do is try and influence it. But to influence it, he's got to make us feel good. And right now, it's saying that commercial and industrial loans are contracting, meaning that these commercial accounts, they're not rolling over loans, they're not making new loans, they're not making new investments. Here's total consumer credit outstanding, and it has collapsed from about 2.9 trillion to 2.4 trillion. So that's a contraction. Here's real estate loans at all commercial banks. It's contracted from about 3.9 trillion to 3.6 trillion. So it's going down. And you can see this one, it's hard to see here. I'm going to enlarge this chart. There's a vertical step right there. And this is some sort of manipulation. Whenever you see this, a chart that's going along and then it takes this big old leap, that's not the public going out and suddenly in 1 month just like borrowing all this currency into existence. It's a manipulation by the Federal Reserve. So what you've got to really do in your mind is match these lines back up as though that big, huge vertical step didn't really happen. And what you see is deflation. That's deflation of the currency supply. When loans contract, people are taking currency and paying down loans, or they're not renewing loans like revolving credit, loans that just roll over month after month. If the banks don't allow you to roll over a loan and they call that loan in, it's deflationary. Here's bank credit of all commercial banks. It's gone flat, but it's got these jags in it again where something is being manipulated. There's this vertical leap, and then it goes down, and another vertical leap, and then it goes down. Take those and sort of paste them together, and you get an idea of what it would be without the Fed's manipulation, and it's contracting. Then we go back. This is consumer individual loans at all commercial banks. Whoa! Holy moly! Look at this thing. Talk about a manipulation. It's going up here, and there are little contractions, and then there's this big contraction, and then suddenly, in the first quarter, right at the end of 2009, I'm going to turn this into a longer-term chart, a shorter-term chart. I'm going to go 5 years and update it. Okay. So in the first quarter of 2010, for some reason, they're telling us that consumers, this is consumer individual loans at all commercial banks, that consumers went out, this was just over 800 billion, and suddenly it goes up to 1.3 trillion. What percentage is that? It's an enormous percentage. It's a little less than 50%, but it's way over 40%. So suddenly, in the first quarter of 2010, the public went out and borrowed like 50% more than they already owed. That didn't happen. This is a manipulation. It's the Fed pumping something into the banks. But take this line and let's get rid of the Fed's manipulation and paste it to this one, and what you see is this big old deflation going from about, this was almost 900 billion. It was about 880 billion, and it has contracted, and if you pasted this on here, we're down to about 750 billion, from 880 to 750. That's a contraction of the currency supply. So this is all truly deflationary. Total loans and leases at commercial banks. Again, we have some manipulations going on, but deflation. Total loans and leases, this is sort of a close-up of the same thing. Commercial and industrial loans whoa, look at this. Commercial and industrial loans of weekly reporting large commercial banks. What you see here is that it peaked up at over 800 billion and has suddenly contracted to 600 billion. That's a 25% contraction. This is huge. And this is where our currency supply comes from. Our currency supply is all IOUs, total revolving credit outstanding. Contraction from almost $1 trillion to $800 billion. That's a 20% contraction. You add all of these different total consumer credit outstanding, you add all of these different things up, and you've got what amounts to the currency supply in the United States. So what I'm saying is that deflation is actually happening, and you've got this this epic play that is happening right now, that's unfolding in front of us, where for the first time in history, the entire world is on this IOU-based currency system. We don't use real money anymore. Money, gold and silver, which stores value, is not being used as currency anywhere right now. I believe it will be again. We're on this decade, we'll see the biggest shifts that you've ever seen in your lifetime, and one of those is what I call part of the currency cycle. Every 30 to 40 years, the world has a new monetary system. This is a normal thing. I've been talking about this for many, many years. I haven't written a whole lot on it, but at my live presentations, I talk about it quite a bit. But you had the classical gold standard until World War I. You had something called the gold exchange standard between the wars. You had the Bretton Woods system from 1944 to 1971. And then the dollar standard started in August of 71 till today. And each system, except for the classical gold standard, each system that is a man-made, manipulated system cannot account for all of the forces in the free market. And energy builds up in certain areas, and then the thing starts to self-destruct. That's what we're seeing right now. The euro was such a poorly designed system that it's barely lasted a decade, and here it's already self-destructing. We're going to see all of these debt-based monetary systems self-destructing. There's going to be, in this decade, some big emergency G20 meeting where they're going to hash out another world monetary system, just like they did in 1944 at Bretton Woods, New Hampshire. And the thing is that this isn't something to be afraid of necessarily. Yeah, some bad things might happen, but it's the greatest opportunity ever presented to anybody. If you can do this, is a huge shift in the way the world works, and you can be on one side of it by just going along doing whatever you were doing before, or you can put yourself on the side where you're betting that this thing is going that there's going to be this shift. It's going to happen anyway. And so if it happens, I want to see everybody benefit from it. I don't want to see everybody hurt. So that's my take on $10 oil. I think that $10 oil may happen, or maybe it's $20 oil, or maybe it's $30 oil. But there's going to be a deflation and a pullback that's temporary in commodities before a hyperinflation. I'm not betting that things are going to go down and stay there. I'm buying gold and silver. I still buy gold and silver. I've got a business in it, and I've got a book on it. I bet my life on it. I wrapped my entire life around gold and silver and this shift in this huge convergence of a whole bunch of cycles and a shift of the world monetary system. So take care, and I'll see you next time. Basically, I think that everything that you're hearing here, everything that you've listened to, is a bunch of bullshit. Basel II, Basel III, payment systems, I don't care. Your personal lives are at stake here. Anybody that gets prepared is going to become super wealthy. The ones that don't get prepared in this room are going to become government employees when the government nationalizes the bank system. You're going to be working for the government.